This presentation covers part 2 of when you buy another company's stock and you have to account for it. And this particular presentation focuses on allocating excess over book and when you use the equity method. When the purchase price exceeds the book value of an investment, assets minus liabilities or total equity at the time of the purchase, the difference must first be allocated to under or overvalued assets and liabilities. The reason is fair value of some assets and liabilities are different from their book values. The investor may be willing to pay extra because future benefits are expected to accrue from the investment. The excess over fair value of the investment not assigned to specific assets, which we must always do first. We must first assign to under or overvalued specific assets or liabilities. The difference is assigned to goodwill as an intangible asset subject to impairment, because we don't amortize goodwill. We subject it to impairment. When a company again pays more than the book value, source of the difference, assets, liabilities that are under or overvalued on the investee's books, we first assign excess here, and only the difference goes to goodwill, and we're going to amortize intangible assets and depreciate tangible assets, PP&E, and the difference, and it's only the difference of the remaining useful lives of the associated assets unless the asset's life is indefinite. Goodwill will be carried forward without adjustment until the investment is sold or a permanent decline in value occurs, and then we have an impairment loss. Now let's take a look at an example. Big company is negotiating to acquire little company stock. Little's balance sheet reports assets of $500,000 and liabilities of $300,000. After investigation, Big determines that Little's equipment, which has a 5-year remaining life, is undervalued by $60,000. Also, one of Little's patents has a 10-year remaining life, is undervalued by $40,000. On January 1st of 2017, Big offers $120,000 for a 30% share of the investee's outstanding stock. At the end of 2017, Little had net income of $100,000 and paid dividends of $12,000, and in 2018 had net income of $120,000 and paid dividends of $15,000. So now, what are we going to solve for? Well, first, what would be the equity income that would be reported by the parent for each year and the balance in the investment account? And that would assume we were using the equity method, but what if we decided to do that one-time elective and decided instead to use the fair value option for this investment? And the fair market value was $150,000 at the end of 2017 and $165,000 at the end of 2018. So in that case, how much again would we show as equity income and what would be the balance in the investment account? So first we're going to start by using the equity method. So Little's balance sheet reports assets of $500,000 and liabilities of $300,000. What is the net book value? So remember, the accounting formula must always balance. So assets equals liabilities plus equity. So if we know the assets equal $500,000 and the liabilities equal $300,000, we can solve for the equity. So we know we have $200,000 in equity. So the other thing to remember when we're looking at this is sometimes all we're going to get is the equity. So we need to remember that net book value equals assets minus liabilities, or the total equity. So again, remember this because sometimes in the problems you're going to be shown they're only going to give you the equity, the common stock, the paid-in capital, and remember it's always the beginning retained earnings or the retained earnings at the point of the purchase. So now let's take a look and solve this problem. So again, we've got this information, and the first thing we need to do is we need to figure out what is the goodwill. So what I like to do is if I have 100% of the book value, and the assets, I like to convert the consideration to figure out what's the fair market value 100% of the company. So in this case, I would take the $120,000 investment divided by 30%. And again, this is only when they give me 100% of the subs values. I then subtract the net book value and I get my excess over book. This must first be assigned to under or overvalued assets and liabilities. So we're going to assign it to the equipment, which had a 5-year life, and the patent, which had a 10-year life, and that difference is going to be subtracted from the excess, and that's how you come up with goodwill. Now, normally at this point, the next thing I do is figure out what is my share of the amortization or depreciation. In this case, we have both. So the equipment would be $12,000, the patent would be $4,000. The goodwill is indefinite, so there's nothing there. So the annual expense, at least for the first 5 years, is $16,000. But remember, we're only going to record 30% of that. So it's going to be $4,800. Here's what's going to happen. Equity in little company, which would be a reduction of the equity income we're going to report, and we're going to reduce our investment account by $4,800. So again, we're going to decrease the income from the investment and the investment account whenever we have amortization or depreciation. Now, using the equity method, how much would be reported as income on Big's books in 2017 and 2018? Well, first, we would pay 30% of the net income, less the amortization, and that would give us our net income. This would be reported as part of other investment income for 2017. And we would do the same thing for 2018. So this would be, we'd show 25.2 for 2017 and 31.2 for 2018. Now, what about the balance in the investment account? Well, we take our initial investment, we would adjust by the equity income and reduce by the dividends and show the ending balance in 2017 would be $141.6. And then we would again add in the equity income, less the dividends, and now we have the balance at the end of 2018. Now the next question we asked is, what if instead we elected the fair value option? So, how much we reported as investment income? So remember, here's the difference. We're going to record dividend income, but we're also going to record our adjustment to fair market value. So for 2017, it would be 33.6. We're going to do the same thing in 2018 and show that would show 19.5 for our equity income in 2018. Now, what would be the balance in our investment account if we elect the fair value option? Okay, the initial investment would be $120,000, and we adjust for the fair market adjustment to get us up to $150. Remember, dividends have no impact on that investment account. And then again, we would adjust for 2018 to get us up to the $165 balance. And that concludes our Part 2 presentation on how to use the equity method when accounting for investments in other company stock, or the fair value option if we choose to elect that.